Good day everyone, my name is Rizame Ambas and I am going to report about the definition and types of financial statement analysis and the types of financial statements.
Good day everyone, I am Bright Joshua Kabulisan and I am going to discuss financial statements and the different financial statement analysis.
We will discuss first all about different financial statements because we need to understand clearly the components of financial statements so that we can easily understand different important topics about financial statement analysis. A financial statement is an official document that explores the interfinancial information of the firm. Business organizations can be able to see their financial performance through the information included in the financial statements. These financial statements are the document needed by the financial managers to create financial decisions for the business firm. Always remember that the main aim of a financial statements is to provide information and understand the financial aspects of the firm. Therefore, the preparation of financial statements is very important in financial decisions. Additional information lang din po na ang preparation of financial statements belongs to accounting department, while the financial decisions making belongs to the financial management department. However, it is much better that we already have knowledge of how to prepare financial statements for us to analyze.
Alam naman natin na sobrang crucial ng role ng financial statement sa isang entity. From the top management hanggang sa pinakamababa ng isang organization ay hindi mawawala ang finance department. So gaano nga ba ka-importante ang financial statements? Basically, financial statements provides information about the financial health ng isang company. Pinapakita nito yung performance, operations, and yung cash flow ng isang entity, as well as yung revenues and expenses na mag-a-identify sa isang organization kung profitable ba ito. So with that, mas mako-convince ng isang organization yung different stakeholders, especially investors, para mag-invest sa company. So financial statement din ang nakakatulong sa decision making kasi pinapakita nito yung different effects ng bawat transactions made by the organization.
The balance sheet is also called the statement of financial position. It is the financial statement that reports a company's assets, liabilities, and equity at a specific point in time. It helps the financial managers and different users to have a concrete basis for computing rates of return and also in terms of evaluating its capital structure. By looking at the statement of financial position of the company, we will see a snapshot of what the company owns or what we call assets, what the company owes, these are the liabilities, and also the invested money of the owner or shareholders, the equity. In the preparation of the balance sheet, we must remember that the assets of the company should be balanced with liabilities and equity of the firm. Assets are equal to liabilities plus owner's equity. A balance sheet is one of the financial statements used by financial analysts or managers to calculate financial ratios. This is one of the example of balance sheet. As we can see in the upper portion of a balance sheet, the business or organization name M. Santos Company, together with the type of financial statement, balance sheet, and the period covered of the business operation for the year ended December 31, 2011. The balance sheet is composed of three parts: assets, liabilities, and equity. Assets are equal to liabilities plus owner's equity. The total asset has amounted to 441,333 and total liabilities and owner's equity also amounted to 441,333. An income statement is also called a profit or loss account, which reflects the operational position of the firm during a particular period. So normally it composes of one accounting year. It determines the inter-operational performance of the business or an organization. The income statements also helps to ascertain the gross profit and net profit of the firm. This type of financial statements shows if the business firm earns a profit or gets losses. This is one of the examples of the income statement. As we can see in the upper portion of an income statement, the business or organization name M. Santos Company together with the types of financial statement, income statement, and the period covered of the business operation for the year ended December 31, 2011. The income statement is composed of two parts, the revenues and the expenses. In this income statement, all sources of income are recorded as well as the expenses. So, paano po natin malalaman ang net income ng isang business o ng isang organization? By simply deducting all the expenses to the total income. So, based po dito sa example, income statement natin, ang total revenue po ay 119,000 and for the total expenses naman po is 67,511. Idideduct lang po natin sila para makuha ang income before tax which is 51,489. Yung income before tax po na tinutukoy dyan ay pwede rin po nating tawagin as pre-tax earnings. It is a business net income after all operating expenses but no taxes have been paid. So, 51,489 minus 75 will serve as an income tax expense. Income tax is a type of tax that governments imposed on income generated by business and individuals within their jurisdiction. Income tax is used to fund public services, pay government obligations, and provide goods for citizens. Overall, the net income is amounted to 51,414, meaning the M. Santos Company gained profit. If the result of net income is negative, this means that the business got net loss.
Statement of changes in owner's equity or also called as the statement of retained earnings. Pinapakita ng financial statement na ito yung pagbabago, particularly sa capital balance ng isang organization in a given period. Alam naman natin na kapag nag-earn ng profit ang isang organization, is madadagdagan din yung equity nito. And if the owner makes a withdrawal, mababawasan naman yung equity. So basically, nire-reconcile lang ng statement of changes in owner's equity yung beginning and ending capital balance ng isang entity in a given period. Here are the examples of statement of changes in owner's equity. So in a sole proprietor business, changes in owner's equity includes the beginning capital balance. Ito yung ending balance ng nakaraang taon. So, based sa example, makikita natin na yung beginning balance ng year 2020 came from the ending balance ng year 2019. Next is i-add dito yung income or net income na na-earn ng isang entity throughout the period, as well as kung may additional investment ba yung owner. However, if there is withdrawal, ile-less naman siya. So, ganun din sa partnership. Ang pinagkaiba lang nila is, sa sole proprietor, iisa lang na pangalan yung nire-reconcile, which is the owner. So, sa partnership, lahat ng partners and their individual investments or withdrawals yung nire-record. Kapag naman sa corporation, dito na pumapasok yung preference and ordinary shares as well as yung mga dividends. Cash flow statement. It provides information about the cash receipts and cash payments of an entity during a period. So basically, dito sa cash flow statement, pinapakita yung bawat galaw ng cash. It's either cash inflow or cash outflow. And this is calculated using direct or indirect method. Cash flow statement is composed of three activities: the cash from operating activities, cash from investing activities, and cash from financing activities. So, yung cash from operating, ito yung mga transactions na related sa pagkita ng isang entity such as selling of goods or incurring of services. However, sa cash from investing activities naman, it includes acquisition of properties like land, machineries, and equipment na magagamit sa operation ng isang entity. And lastly, the cash from financing activities. Ito naman yung mga investment made by the owner or borrowed amounts from banks and other entities, as well as yung mga drawings at repayments to lenders. Ito yung example ng cash flow statement, wherein makikita natin yung three activities such as operating, investing, and financing activities.
According to Mayers, financial statement analysis is largely a study of the relationship among the various financial factors in a business as disclosed by a single set of statements and the study of the trend of these factors as shown in a series of financial statements. It means that when we are doing financial statement analysis, we will see the relationship of one financial statement to another. So, para po ma-discover natin yung mga relevant information na kinakailangan natin sa decision making. By analyzing the financial statements, we will see as well as the trends of business factors, and by that, the financial managers will be given a concrete basis for their business decisions.
Analysis of financial statement is also necessary to understand the financial positions during a particular period. So according to Myers, mahalagang matutunan natin yung financial statement analysis for us to know kung ano-ano bang factors yung nakakaapekto sa financial health ng isang entity. Financial statement analysis is classified into two: the basis of material used and basis of methods of operations. Sa financial statement analysis based on material use, dito pumapasok yung different stakeholders ng isang entity. What do we mean by stakeholders? So basically, sila yung mga taong either nakakaapekto sa company or sila yung mga naapektuhan ng company's operation. It is classified into two: the external and internal analysis. First, external analysis. Ito ay ginagawa ng mga taong outside the business such as investors, banks, financial institutions, suppliers, government, and tax authorities, and the like are doing the external analysis. So mahalaga to upang malaman kung karapat-dapat bang mag-invest sa ganitong kumpanya or ito bang kumpanya ay may kakayahang magbayad ng pagkakautang sa madaling panahon, or yung entity na to ba ay tama ang binabayad na tax based sa kinikita niya. So with that, nagiging transparent yung isang entity sa kanyang external stakeholders, and doon nabubuo yung trust between both parties. Sa kabilang banda naman is yung internal analysis. It refers to the management itself. So nagko-conduct sila ng analysis para ma-facilitate ng maayos yung operational performance ng isang organization. It helps sa decision-making process ng isang entity para ma-achieve nito yung desired goals.
Magbibigay lang po ako ng konting insights about horizontal analysis kasi po mas i-discuss po yun ng next reporter through solving. Horizontal analysis is used in the review of a company's financial statements over multiple periods. It is usually depicted as a percentage growth over the same line item in the base year. Horizontal analysis allows financial statement users to easily spot trends and growth patterns. The formula for this is an amount in comparison year minus amount in base year over the amount in base year times 100. The vertical analysis makes it easier to understand the correlation between single items on a balance sheet and the bottom line expressed in a percent.
There are 6 techniques in analyzing financial statements. It include comparative statement analysis, trend analysis, common size analysis, fund flow statement, cash flow statement, and lastly, ratio analysis. Comparative statement analysis. It is an analysis of financial statement at different period of time. So, this statement helps us to understand the comparative position of financial and operational performance ng isang entity from the different period of time. So, comparative financial statements is classified into 2 major parts such as comparative balance sheet and comparative profit and loss account analysis. So, the benefit of this comparative statement analysis is it provides a comparison of an entity's financial performance over multiple periods so that you can determine the trends. And the statements may also reveal unusual spikes in the reported information that can indicate the presence of accounting errors. Comparative balance sheet analysis. So this kind of comparative statement analysis concentrates only sa balance sheet ng isang entity from the different period of time. So under this analysis, the balance sheets are compared with previous year's figures or 1-year balance sheet figures are compared with the other years. So comparative balance sheet analysis may be horizontal or vertical basis. And this type of analysis helps to understand the real financial position ng isang entity as well as how the assets, liabilities, and capitals are placed during a particular period. Here is the example of comparative statement of financial position. So sa left side, makikita dito yung balance sheet ng MCC Manufacturing Company from the year 2018 up to 2021. And sa right side naman is the comparative balance sheet analysis ng year 2018 and year 2019. So sa analysis na ito ay gumamit tayo ng horizontal analysis wherein kino-compare natin for instance yung cash na meron noong 2018 at cash noong 2019. So to know if an account increases, just subtract the current year from the previous year, and if negative naman yung lumabas, it means na nag-decrease yung account na yon. And para naman malaman kung ilang percent yung itinaas or ibinaba ng isang account, just divide the increase or decrease amount sa previous year. Another comparative financial statement analysis is comparative profit and loss account analysis. So under this analysis, only profit and loss account or yung income statement na tinatawag natin yung kino-compare from different period of time. So this analysis helps us to understand the operational performance of the business concern in a given period. So as a small business owner, kailangan malaman natin yung kung paano ba gawin to. And if you don't, how do you know if the decisions you make for your business are working? So looking at a comparative income statements helps us to analyze the profitability over time. Also, comparative income statement can reveal if your costs and revenues are consistent. For instance, in 3 years of your cost of goods sold goes from 25% of sales to 40% of sales, by recognizing the increase of sales, you can find solutions to reduce cost of goods sold. And as a business investors naman, they use it to look different companies. So the comparison helps them decide which business is a better investment. Here is the example of comparative profit and loss account analysis. So same as comparative balance sheet din yung process nito. Just subtract the current year from the previous year, and if negative yung lumabas, it means na nag-decrease yung isang account. So para naman malaman yung percent kung gaano ba yung itinaas or ibinaba ng isang account, just divide the increase or decrease amount sa previous year.
Trend analysis is an analysis of the trend of the company by comparing its financial statements to analyze the trend of the market, or analysis of the future on the basis of results of past performance, and it's an attempt to make the best decisions on the basis of results of the analysis done. It evaluates the organization's information over a period of time. Periods may be measured in months, quarters, or years depending on the circumstances. So, ginagawa po ang trend analysis to calculate and analyze the amount change and percent change from one period to the next. The formula for this is current year minus base year all over base year times 100. We will see in the given example the computed trend percentage of the total sales revenue, operating expenses, and net income of the company. To compute the trend percentage, the base year, which is the year 2014, will be automatically 100%. Then, based on the formula, perform the horizontal analysis first, then after you get the result, add the trend percentage of the previous year to the computed percentage of the current year. Let us focus first on the total sales revenue portion for the year 2014 and 2015. To get the trend percentage of 2015, we have 550,781 minus 500,710. That will give us the result of 50,071. Then yung 50,071, divide it by 500,710, that is the base year, then multiply it by 100. If you perform the operation, you will get 10%. So now add this 10% to the 100%. 10% of 2014, then you will get a 110%. Perform the same operation on 2016 up to 2018, then same operations lang din po sa operating expense and net income.
Another financial statement analysis techniques are common size analysis. It is also known as the vertical analysis, in which figures reported are converted into percentage to some common base. So in the balance sheet, the total asset figures is assumed to be 100 and all figures are expressed as a percentage of this total. It is one of the simplest methods of financial statement analysis, which reflects the relationship of each and every item with the base value of 100%. So here are the benefit of common size analysis. It allows investors to identify serious changes sa company's financial statement. It mainly applies when the financials are compared over a period of 2 or 3 years. So any significant movements in the financials across several years can help investors decide whether to invest in the company. So for example, large drops in the company's profits in 2 or more consecutive years may indicate that the company is going through financial distress. So similarly, considerable increases in the value of assets may mean that the company is implementing an expansion or acquisition strategy, making the company attractive to investors. Second benefit of common size analysis is it is an excellent tool to compare companies at different sizes but in the same industry. So looking at their financial data can reveal their strategy and their largest expenses that give them a competitive edge over other comparable companies. So for instance, some companies may sacrifice margins to gain a large market share, which increases revenues at the expense of profit margins. Such a strategy allows the company to grow faster than comparable companies because they are more preferred by investors. Here is the example of common size analysis ng income statement. As what I've said kanina, na kapag sa income statement or statement of profit and loss account, ang base item ay yung revenue. So from our example of income statement, sa comparative statement of income, dinidivide lahat ng account sa sales revenue.
The fund flow statement is one of the important tools which is used in many ways. It helps to understand the changes in the financial position of a business enterprise between the beginning and ending financial statement dates. It is also called the statement of sources and uses of funds. So ano nga ba ang silbi nitong fund flow statement? The fund flow statement describes the sources from which additional funds were derived and the uses to which these funds were put. From this definition of funds flow, klaro nating maintindihan na ang fund flow statement ay ginagamit para makita ng company kung saan nanggagaling ang funds at kung paano ito ina-apply or ginagamit ng isang company. The fund flow statement format clearly shows the different sources from which funds are obtained in use to which funds are put. In a given example, the funds generated from operating activities and the proceeds from the issue of shares capital have been identified as the source of funds. Moreover, we can see as well that the application of funds is also recorded. So makikita po natin kung saan napunta yung funds ng company. Again, this is the reason kung bakit tinatawag din ang statement na to na statement of sources and users of funds. Now, in terms of preparation of the funds flow statement, please take note of these following guidelines. General rules for preparing fund flow statement. An increase in a current assets, also increase in working capital. Decrease in a current asset, decrease in working capital. Increase in current liabilities, decrease in working capital. Decrease in current liability, increase in working capital. Increase in current assets and increase in current liability does not affect working capital. Decrease in current assets and decrease in current liability does not affect the working capital. Changes in fixed non-current assets and fixed non-current liabilities affects working capital.
Cash flow statement. So to reiterate this kind of statement as what I've said kanina, it is a statement which shows the sources of cash inflow and uses of cash outflow of an entity during a particular period of time. So take note that funds flow and cash flow statement are two different statements na ginagamit sa analysis. First, kapag fund flow statement, makikita natin na yung movement ng funds or ng working capital ng company. However, working capital pertains to the amount of available capital that the company can readily use for day-to-day operations. On the other hand, kapag cash flow statement, it is the report showing the sources and uses of cash. Second, fund flow statement explains how working capital is raised and used during a particular period. So makikita natin sa funds flow statement kung saan nanggagaling ang working capital ng company, pero sa cash flow statement hindi mo yun makikita dahil ang makikita mo lang sa cash flow statement ay yung inflow at outflow ng cash. Third, the main objective of fund flow statement ay mapapakita kung paano ba na-manage ng company ang capital resources, pero ang objective ng cash flow ay maipakita yung causes ng changes sa outstanding balance ng cash ng isang entity. Fourth is the other difference is that kapag fund flow statement, changes in working capital is recorded, pero sa cash flow statement, yung nire-record doon ay yung cash receipts at cash payments. Lastly, at isa sa pinakamalaking pagkakaiba ng fund flow statement at ng cash flow statement ay yung beginning at ending balances. When we are talking about these balances, walang makikitang beginning at ending balance sa fund flow statement, pero sa cash flow statement ay meron.
Ratio analysis is the comparison of line items in the financial statements of a business. Ratio analysis is used to evaluate a number of issues with an entity, such as its liquidity, efficiency of operations, and profitability. This type of analysis is particularly useful to analysts outside of a business since their primary source of information about an organization is its financial statements. Ratios are useful tools in expressing relationships among data that can be used for internal comparison across firms. From the point of view of financial management, there are four types of ratio analysis: liquidity ratio, activity ratio, solvency ratio, and profitability ratio. The liquidity ratio is also called a short-term ratio. This ratio helps to understand the liquidity in a business, which is the potential ability to meet current obligations. This ratio expresses the relationship between current assets and current liabilities of the business during a particular period. Always remember na kapag pinag-uusapan natin ang liquidity ratio ng isang company, we are pertaining to current and quick ratio. Again, ginagamit natin ang liquidity ratio para malaman natin ang capacity ng isang company na ma-meet ang kanilang current obligations. The current ratio measures the ability of your business to pay your current liabilities using your current assets. There are many assets type, but we only use the current assets in your current ratio calculation. Current assets are assets that can be converted into cash within 1 year. Current assets may include the following: cash equivalent, account receivables, prepaid expenses, inventory, securities, and etc. So, look at the given example of the comparative statement of financial position of Pinoy Pride Handicrafts. Take note of these guys na kapag current and quick ratio ang i-compute natin, we are using comparative statement of financial position as our point of reference. To compute the current ratio, we need to consider its formula, current assets over current liabilities. Then, we will just substitute the value of the given formula, so we have 22.87 as the current ratio of Pinoy Pride Handicrafts. This shows that for every 1 peso that a company has in its current liabilities, they have 22.87 pesos worth of current assets. Always remember that a good current ratio is 2, indicating you have twice as much in assets as liabilities. A current ratio of less than 2 may indicate financial issues and an inability to pay off current debts, while a current ratio over 4 may indicate that your business is not using its assets efficiently. In our given example, the computed current ratio is 22.87. The quick ratio is a calculation that measures a company's ability to meet its short-term obligations with its most liquid assets. The formula for this is quick ratio is equals to quick asset over quick or current liability. When we're computing the quick ratio, you need to consider those quick assets of the company. Ito yung mga assets na madaling i-convert into cash or its cash itself. All current liabilities must be included in the calculation of the quick ratio. So, in our given example, the computed quick ratio of Pinoy Pride Handicrafts year 2014 is 21.63 after applying the formula. The ideal or recommended quick ratio be at least 1, indicating that for every peso you have in liability, you have 1 peso in your assets.
Another ratio na ginagamit ng mga financial analyst ay yung activity ratio. It is called as turnover ratio and it measures the efficiency of the current assets and liabilities in the business during a particular period. And this ratio is helpful to understand the performance of an entity. So under this ratio, we have stock turnover ratio, debtor turnover ratio, creditors turnover ratio, and working capital ratio. Stock turnover ratio, also known as the inventory turnover ratio. It is an efficiency ratio that measures how inventory is being managed. So the inventory turnover ratio's formula is equal to cost of goods sold divided by the average inventory to show how many times does the inventory is turned or sold during a particular period, where the cost of goods sold is the cost attributed to the production of goods that are sold by an entity over a certain period, and it can be found on the company's income statement, and the average inventory is the mean value of inventory throughout a certain period. Take note that the analyst may use either average or end of period inventory values. So the ratio can be used to determine if there are excessive inventory levels compared to sales. In other words, it measures how many times a company sold its total average inventory peso amount during a year. And this ratio is important because total revenue depends on two main components of performance. The first component is the stock purchasing. So if a larger amounts of inventory are purchased during the year, the company would have to sell a greater amount of inventory to improve its turnover. If the company can sell these greater amounts of inventory, it will incur storage costs and other holding costs. The second component is sales. If sales have too much inventory purchases, otherwise the inventory will not turn effectively. That is why the purchasing and sales department must be in tune or coordinated with each other. Here is an example of stock turnover ratio. So in the given financial data of BJC Corporation, the inventory for the year 2018 is amounted to 550,000, and for 2019 it is 450,000. For the company's cost of goods sold or cost of sales is 800,000 pesos. So here is the computation of the inventory turnover for the year 2019 using the given formula. First, we have to get the average inventory. So to compute, add both inventory balance of 2018 and 2019, then divide it by 2. Then divide the cost of goods sold sa average inventory such as 800,000 over 500,250 pesos, and it is equal to 1.60. To interpret the result or the computed inventory turnover ratio, we need to remember that it is an efficiency ratio that measures how well a company can manage its inventory. It is important to achieve a high ratio dahil the more na mataas ang ratio, it reduces storage and holding costs. It is vital to compare the ratios between companies operating in the same industry and not for the companies operating in different industries. So the benchmark ratio varies greatly depending on the industry. Low turnover implies that a company's sales are poor. It is carrying too much inventory or experiencing poor inventory management. Unsold inventory can face significant risk from fluctuating market prices and obsolescence. So depending on the industry that the company operates in, inventory can help determine its liquidity. For instance, inventory is one of the biggest assets that retailers report. If a retail company reports a low inventory turnover ratio, the inventory may be obsolete for the company, resulting in lost sales and additional holding costs. Another ratio under activity ratio is the debtors turnover ratio, also known as accounts receivable turnover ratio. It is an efficiency ratio that measures how a company is collecting revenue and by extension, how efficiently it uses its assets. The account receivable turnover ratio measures the number of times over a given period that the company collects its average accounts receivable. It is just simply means that it shows the number of times per year bago nila makolekta ang kanilang accounts receivable. So the formula of this efficiency ratio is net credit sales over average accounts receivables, wherein net credit sales are sales where the cash is collected at the later date. The formula for net credit sales is sales on credit minus sales return minus sales allowances. Then the average accounts receivable is the sum of starting and ending accounts receivable over a time period, then divide it sa 2. Sarap Mag Bike Shop is a retail store that sells cycling equipment and bicycles. Due to declining cash sales, Ian Howe, the owner, decides to extend credit sales to all of his customers. In the year ended December 31, 2020, there were 100,000 pesos gross credit sales and returns of 10,000 pesos. Starting and ending accounts receivable were 10,000 and 15,000 pesos respectively. Ian Howe wants to know how many times his company collects its average accounts receivable over the year. So we have the formula for accounts receivable turnover ratio, that is net credit sales over the average accounts receivable. By applying the formula, lumabas yung 7.2, which means that the Sarap Mag Bike Shop have collected its accounts receivable for approximately 7.2 times over the year ended December 31, 2020. So in order to identify how many days does the company collected its accounts receivable, just divide 365 days into the receivable turnover ratio. And based nga sa problem, there is approximately 50.69 or 51 days that the Sarap Mag Bike Shop have collected its accounts receivable. Next is the creditors turnover ratio, also known as the payables turnover ratio. It measures the average number of a company pays its creditors over an accounting period. So this ratio measures a short-term liquidity, and with a higher payable turnover ratio is being more favorable. So the formula to get the creditors turnover ratio is net credit purchase over average accounts payable. Take note that in some cases, cost of goods sold is used in the numerator in place of net credit purchase. Average accounts payable in the sum of accounts payable at the beginning and end of a company at a given period, then divide it by 2. MCC Company reported annual purchases on credit of 123,555 and returns of 10,000 during the year ended December 31, 2021. Accounts payable at the beginning and end of the year were 12,555 and 25,121 respectively. The company wants to measure how many times it paid its creditors over the year. So by applying the formula of net credit purchase over the average accounts payable, it resulted to 6.03 in this ratio. The result should be rounded off, therefore, the MCC company have paid its creditors 6 times over the year ended December 31, 2021. Working capital turnover ratio. It helps in determining how efficiently does the company is using its working capital. So we have current assets minus current liabilities in order to get the working capital. This ratio is calculated by dividing the net sales to the working capital of an entity during a period. It signifies how well the company generates its sales with respect to the working capital of the company. So a higher working capital turnover ratio, the better. In the given example, we have MCC company's financial information. Sabi nga natin kanina, to get the net working capital, we need to deduct the company's current liabilities from the current assets, resulting to 6,062,132.07 for the year 2019 and 9,652,626.01 for the year 2020. To get the working capital turnover ratio, just divide the sales revenue to the net working capital, resulting to 1.27 for 2019 and 0.86 for 2020. In interpreting this ratio, a higher ratio generally signals that the company is generating more revenue with its working capital. Kapag mas mataas ang current assets sa current liabilities, then the working capital will be a positive number. It is crucial to look at working capital ratio across ratios and also in comparison the industry to make a good analysis of the working capital.
Solvency is a key metric used to measure an enterprise's ability to meet its debt obligations and is used often by prospective business lenders. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short and long-term liabilities, also known as stability ratio. Sinusukat nito ang kakayahan ng isang kumpanya kung kaya ba nito makapagbayad ng mga utang. So if the company cannot pay its obligations, it will result in bankruptcy. The debt ratio measures the percentage of assets funded by creditors. The formula for this is total liabilities divided by total assets. Pinapakita sa debt ratio kung gaano kalaki ang shares ng mga pinagkakautangan or what we call the creditors sa total assets ng kumpanya. Ang magiging point of reference po natin dito ay ang balance sheet. The debt-to-equity ratio indicates the percentage of assets funded by owners, total equity over total asset. The debt-to-equity ratio ay pinapakita kung ilan ang percentage ang shares ng owner o claims ng owner sa total assets ng business. This time, balance sheet pa rin po ang magiging point of reference natin. The time interest earned evaluates the ability of a company to pay the interests on its debt. The formula for this is interest coverage ratio is equals to earnings before interest and taxes over interest expense. Makikita sa ratio na ito kung kaya ng isang company na magbayad ng interest sa mga inutang nito. Ang magiging point of reference po natin dito ay ang income statement. We are going to compute first the debt ratio. The formula for this is total liabilities divided by total assets. In this given sample, we are going to compute the total liabilities. Short-term debt amounted to 30,000 plus long-term debt amounted to 40,000, a total of 70,000 for total liabilities. Given the 140,000 as total assets, by applying the formula, 70,000 divided by 140,000 is equals to 0.50. For every peso of assets acquired and controlled by the company, it's 50 centavos financed by debt. And of course, the remaining 50 centavos would come from equity. In short, 50% of the assets book value is funded by liabilities, especially debt. So now, let us proceed to the debt-to-equity ratio. The formula for this is total liabilities divided by total equity. The value for total liabilities is 70,000 and for total equity is 70,000 as well. Let us divide them by applying a formula. The debt-to-equity ratio will be 1 peso for every peso of equity financing the assets of the company. There is 1 peso of debt. A lower debt ratio and lower debt to equity ratio would mean a better chance of survival for the company. And lastly, the time interest earned with the formula of interest coverage ratio is equals to earnings before interest and taxes over interest expense. In this sample, the value of earnings before interest and taxes is 15,000 and for the interest expense is 6,000. Divide them by applying the formula, we will get 2.5 times the operating income of OQ or company corporation can cover the interest expense 2.5 times over. The higher the times interest earned, the better chance of survival company has.
Profitability ratio measures the company's ability to earn a profit relative to its sales revenue, operating costs, balance sheets, assets, and shareholders' equity. It is composed of gross profit ratio, net profit ratio, operating profit ratio, and return on investment. First is the gross profit ratio. It is typically the first profitability ratio by the business. It measures how much sales income a company has left over after it covers the cost of goods sold, and this figure is known as gross profit margin. This ratio is calculated using the figures that is available in the company's income statement. It is calculated by dividing the gross profit or the difference of total revenue and cost of goods sold sa net sales or total revenue, then multiply it to 100. In the given example, the gross profit margin is 61.74% or 62% rounded off. This means that for every peso generated, 0.38 or 38% will goes to the cost of goods sold, while the 62% could be used to pay back the expenses, taxes, and different expenses of the company. Net profit ratio, also known as net profit margin ratio, is a financial ratio used to calculate the percentage of profit of a company produces from its total revenue. It measures the amount of net profit of the company obtained per peso of revenue gained. It is calculated by dividing the company's net profit, also known as net income, to its revenue expressed as percentage. Using the formula for the computation of net profit ratio, you can easily compare which of the two companies has the higher net profit margin. Using the formula given, the company XYZ's net profit margin is 30% and the company ABC gets a 35.56% net profit margin. It only means that the company ABC has a higher net profit margin. Take note that a higher net profit margin means that company is more efficient at converting sales into actual profit. Operating profit ratio or operating profit margin is a profitability or performance ratio that reflects the performance of the profit of an entity produces from its operations prior to deducting taxes and interest charges. And it is calculated by dividing the operating profit by total revenue and express it as percentage. Operating profit is calculated by subtracting all of the cost of goods sold, depreciation and amortization, and all of the other relevant operating expenses from total revenues. Operating expenses includes a company's expenses beyond direct production costs such as salaries and benefits, rent and related overhead expenses, research and development costs, and other expenses. The earning is also known as EBIT or earnings before interest and tax. As you can see sa example, Operating profit ratio can be computed by dividing the income before tax by the total sales of the company. Operating profit margin differs across industry and is often used as a metric for benchmarking of one company against companies with the same industry. It can reveal the top performers within an industry, and it is also indicator of the need for further research regarding why a particular company is outperforming or falling behind its peers. Return on investment or ROI. Isa sa financial ratio used to calculate the benefit that an investor will receive in relation to their investment cost. It is most commonly measured as net income divided by the original capital cost of investment. Jimwell purchased a property amounting to 850,000 pesos. 2 years later, he decided to sell the property for 1,455,000 pesos. So, yung ROI is equals to 1,455,000 minus 850,000 divided by 850,000, resulting to 0.7117 or 71%. It only means that Jim Wells' return exceeds his cost. Analysts or financial managers consider the investment a net gain. If the result is negative, it means that the cost outweigh return and it is considered as a net loss. Consequently, when comparing two or more investments and when the risk and other factors are equal, the investment with the higher return is the most preferred.
So, hi everyone, my name is Jackie C. Pinalbur, and for today I will be reporting about the definition of bonds, the different type of bonds, and what is bond price. So, for my first topic, I will be defining what is bond. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond can be thought of as an IOU. So, ang IOU is a document that acknowledges the existence of a debt between the lender and borrower that includes the details of the loan and its payment. Bonds are used by the companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of the bonds are the debt holder or the creditors of the issuer. Bond details include the end date, when the principal of the loan is due to be paid to the bond owner, and usually include the terms for variable or fixed interest payments made by the borrower. So, ang bonds po sa simpleng salita ay ang loan or ang perang pinahiram mo sa mga kumpanya na tinatawag na corporate bonds, at pwede rin ito sa gobyerno. Sa bonds ay nagpahiram ka ng pera sa isang kumpanya o gobyerno at ibabalik nila ang pera na iyon na may karagdagang interest na naaayon sa maturity date nito. Katulad na lang ng stocks at mutual funds, ang bonds ay isa rin sa kilalang investment. Pero di tulad ng stocks kung saan mabilis ang pagtaas at pagbaba ng presyo ayon sa napakaraming factors o pangyayari. Halimbawa ay kung gaano kaayos ang pagkilos ng kumpanya at marami pang iba. Ang mga bonds ay mas stable o hindi mas mabilis magbago-bago ang presyo. Hindi mabilis ang paggalaw nito dahil ang halaga nila bilang investment ay nakataya sa kanilang interest, maturity date, bond rating, interest rate sa gobyerno at iba pa. Ang mga bonds tulad din ng mga stocks ay pwedeng bilhin o ibenta sa iba, pero ang presyo o halaga nito ay mag-iiba ayon na lamang sa mga factors na nakatulad sa taas. So ngayon na alam na natin kung ano ang ibig sabihin ng bonds, we are going to know naman kung ano ang different type of bonds. There are 3 types of bonds, which is the corporate bonds, high-yield bonds, and the municipal bonds. And under the municipal bonds, there are 2 more types, the general obligation bonds and the revenue bonds. So, for the first type of bonds, which is the corporate bond, those investors who buy corporate bonds are lending money to the company issuing the bond. In return, the company makes a legal commitment to pay interest on the principal and, in most cases, to return the principal when the bond comes due or matures. For our better understanding, it is helpful for us to compare it with a stock. When you buy a share of a common stock, you own an equity of the company and you will receive any dividends declared and paid by the company. When you buy a corporate bond, you do not own any equity in the company. You will just receive only the interest and principal on the bond, no matter how profitable the company becomes or how high its stock price climbs. But if the company runs into a financial difficulties, it still has a legal obligation to make timely payments of interest and principal. The company has no similar obligation to pay dividends to shareholders in a bankruptcy. Bonds investors have priority over shareholders in claims on the company's asset. And for the second type, it is the high yield bonds. A high yield bond is a type of corporate bonds that offers a higher rate of interest because of its higher risk of default. When a company with a greater estimated default risk issue bonds, they may be unable to obtain an investment grade bond credit rating. As a result, they typically issue bonds with the higher interest rates in order to entice the investors and compensate them for this higher risk. A high yield or junk bond is pretty much the same as a regular corporate bonds since they both represent debt issued by a firm with the promise to pay interest and return the principal at maturity. Junk bonds differ because of their issuer poorer credit quality. And for the last type of bond, it is the municipal bonds. Municipal bonds, or munis for short, are the debt securities issued by states, cities, and countries and other governmental entities to fund the day-to-day obligations and to finance the capital projects such as building schools, highways, or sewer systems. By purchasing the municipal bonds, you are in effect of lending the money to the bond issuer in exchange for a promise of regular interest payments, usually semi-annually and in return of the original investment or principal. The advantage of the municipal bonds for investor is the fact that they are tax exempted, meaning that the returns from such bonds are not subject to taxes. It makes it a highly attractive investment for individuals who are in high tax bracket. And under the municipal bonds, there are two most common types of it. The general obligation, which is the municipal bond backed solely by the credit and taxing power of the issuing jurisdiction rather than the revenue from a given project. General obligation bonds are issued with the belief that a municipality will be able to repay its debt obligation through taxation or revenue from the projects. No assets are used as collateral. General obligation bonds also serve as a way for a local government to raise funds for the projects that creates streams of income for things such as roads, parks, equipment, and bridges. General obligation bonds are usually used to fund government projects that will serve the public community. Next is the revenue bond. A revenue bond is a category of municipal bond supported by the revenue from a specific project, such as toll bridge, highway, or local stadium. Revenue bonds that finance income producing projects are thus secured by a specific revenue source. Typically, revenue bonds can be issued by any government agencies or fund that is managed in the manner of a business, such as entities having both operating revenue and expenses. Example of it is a toll revenue bond that used to build a public project such as bridge, tunnel, or expressway. Revenues from tolls paid by user of the public project pay the principal and interest payments on the bonds. For my last topic, it will be about the bond price. So, bond price is the present discounted value of the future cash stream generated by a bond. It refers to the sum of the present values of all likely coupon payments plus the present value of the par value at maturity. Price is important when you intend to trade bonds with other investors. A bond price is what investors are willing to pay for an existing bond. If you buy a new bond and plan to keep it to maturity, changing prices, market interest rates, and yields typically does not affect you unless the bond is called. But investors don't have to buy bonds directly from the issuer and hold them until maturity. Instead, bonds can be bought from and sold to other investors on what's called the secondary market. Similar to stock, bond prices can be higher or lower than the face value of the bond because of the current economic environment and the other financial health of the issuer. Bond prices are determined by what someone is willing to pay, a bid price based on the issuer, its credit rating, coupon rate, time left until the maturity and special redemption features, and what a bond owner would like to receive an offer or ask price. Bond prices reflected on statements are best effort estimates, useful for evaluating a portfolio and establish an allocation mix. However, they should not be interpreted as actual sales price or actual bids.
Good day everyone, my name is Kyla Maxine Madridano and I'll be going to discuss the topic which are what is yield, what is clean and dirty price.
Ano nga ba ang yield? Yield refers to the earning generated and realized on an investment over a particular period of time. Ang yield ay expressed as percentage base sa invested amount, current market, or yung face value of the security. Include din sa yield ang interest earned or yung dividends na nare-receive from holding a particular security. Ang yield din ay isang sukatan ng cash flow na nakukuha ng isang investor sa amount invested in a security. Kadalasang kinukompute ito sa annual basis kahit na yung iba pang variation tulad ng quarterly at monthly yields ay ginagamit din. Hindi rin dapat malito ang yield sa total return na isang mas comprehensive measure ng return on investment. Ang formula ng yield ay yield is equal to net realized divided by principal amount. For example, the gain and return on stock investment can come in two forms. Ang una, it can be in terms of price rise, na kung saan ang investor ay nag-purchase ng stock at 1,000 pesos per share. And after a year, binenta ito na for 1,200 pesos. Pangalawa, the stock may pay a dividend, say, of 20 pesos per share during the year. And the yield would be the appreciation in the share price plus any dividends paid divided by the original price on the stock. The yield for the example would be 200 plus 20 divided by 1,000 is equal to 0.22 or 22%. At since ang higher yield value ay nag-indicates that an investor ay able to recover higher amounts of cash flow in their investment, ang higher value ay often perceived as an indicator ng lower risk and higher income. However, care should be taken to understand the calculation. Ang high yield pwedeng magresulta ng pag-fall ng market value of the security, which is nag-decrease sa denominator value na ginamit na formula, at increases the calculated yield value even when the securities valuation are on a decline. While many investor naman ay prefer dividend payments from stock, at importante rin na to keep an eye on yields. Kapag ang yields ay tumaas, it may indicate that either the stock price is going down or yung company is paying high dividends. Since ang dividends ay paid from the company's earnings, ang higher dividend payouts could mean na ang company's earnings ay on the rise, which could lead to higher stock prices. Higher dividends with higher stock prices should lead to a consistent or marginal rise in a yield. However, a significant rise in a yield without a rise in the stock price may mean that the company is paying dividends without increasing earnings, and that may indicate near-term cash flow problems. Next naman is yung types of yields. Yields can vary based sa investment security, the duration of investment, at yung return amount. At yung mga types na to ay yung yield on stock, yield on bonds, yield to maturity, yield to worst, at yung yield to call. Ang unang type is yung yield on stock. Ito ay calculated base sa purchase price. Ang yield na to ay tinawag na yield on cost or yung cost yield, at calculated siya as cost yield is equal to price increase plus dividend paid divided by purchase price. For example, if an investor realized a profit of 20 pesos from 120 minus 100 resulting from price rise, and also gain 2 pesos from a dividend paid by the company. Therefore, the cost yield comes to 20 plus 2 divided by 100 is equal to 0.22 or 22%. However, many investors may like to calculate the yield based on the current market price instead of purchase price. This yield is referred to as the current yield and is calculated as current yield is equal to price increase plus dividend paid divided by current price. For example, the current yield comes to 20 plus 2 divided by 120 is equal to 0.1833 or 18.33%. Kapag ang company stock ay nag-increase, the current yield goes down because of the inverse relationship between yield and stock price. Next type is yield on bonds. Ang yield on bonds that pay annual interest ay pwedeng i-calculated in a straightforward manner at tinatawag na nominal yield, which is calculated as nominal yield is equal to annual interest earned divided by the face value of bond. For example, if there is a treasury bond with a face value of 1,000 pesos that matures in 1 year and pays 5% annual interest, yung yield niya is calculated as 50 divided by 1,000 is equal to 0.05 or yung 5%. However, the yield of floating interest rate bond, which pays a variable interest over its tenure, will change over the life of the bond depending upon the applicable interest rate at different terms. Next is yung yield to maturity. Ang yield to maturity ay ang total return anticipated sa bond kapag ang bond is held until it matures. Itong yield to maturity is considered as long-term bond yield pero expressed as an annual rate. It also a special measure ng total return expected on a bond each years if ang bond is held until maturity. Iba ito sa nominal yields, which is usually calculated sa per year basis and yung subject to change with each passing year. Ang yield to maturity ay average yield expected per year at ang value ay expected to remain constant throughout the holding period until the maturity of the bond. Next naman is yung yield to worst. Ito naman ay measure sa lowest potential yield that can be received sa bond without the possibility of the issuer defaulting. Ito rin ay nag-indicate sa worst case scenario sa bond by calculating the return that will be received kapag ang issuer ay gumamit ng mga provision including prepayments, callbacks, or yung sinking fund. Itong yield na to ay nagpo-form ng isang important risk measure at ini-ensure yung certain income requirements na matugunan kahit nasa worst scenario. Last type is yung yield to call. Dito naman ay refer sa return a bondholder na na-receive kapag ang security is held until the call date, prior to its date of maturity. Ang yield to call is a measure linked sa callable bond, a special category of bond na pwedeng i-redeem by the issuer prior sa maturity. Ito rin ay refer sa bond yield at the time of its call date. Itong value na to ay determined by the bond's interest payments, market price at sa duration until the call date as that period define the interest amount. Next is yung yield curve. Ang yield curve ay isang line that plots yields or yung interest rate ng isang bonds having equal credit quality pero differing maturity dates. Yung slope ng yield curve ay nagigive ng isang idea sa future interest rate changes at economic activity. A yield curve is used as a benchmark for other debt in the market, such as mortgage rates or yung bank lending rates, and it is used to predict changes in economic output and growth. Mayroong three types ng yield curve. Ang una dyan yung normal or yung upward sloping curve. Yung pangalawa yung inverted or yung downward sloping curve, and yung flat. A normal yield curve indicates yields on longer term bonds may continue to rise, responding to periods of economic expansion. Ang normal yield curves nag-i-start with low yields for shorter maturity bonds and then mag-i-increase for bonds with longer maturity or yung sloping upwards. Ito rin ay yung most common type of yield curve as longer maturity bonds usually have a higher yield to maturity than shorter term bonds. Next is yung inverted yield curve. Ang inverted yield curve instead slope downward and means that short-term interest rates exceed long-term rates. Such a yield curve corresponds to periods of economic recession, kung saan yung mga investor nag-expect ng yield on longer maturity bond to become even lower in the future. Moreover, in an economic downturn, investors seeking safe investment tend to purchase these longer dated bonds over short dated bonds, bidding up the price of longer bonds, driving down their yield. Next is yung flat. Ang flat yield curve is defined by similar yields across all maturities. A few intermediate maturities may have slightly higher yields, which causes a slight hump to appear along that flat curve. These humps are usually for the mid-terms maturities or yung 6 months to 2 years. Next is yung difference between bond price and yung yield. Ang una dyan, yield has an inverse relationship with bond price. Ang ibig sabihin, kapag ang price nag-increase, ang yield naman magdi-decrease, and vice versa. Pangalawa, the change in bond yield affects the bond price and vice versa. Kapag ang bond yield tumaas, and yung price naman magdi-decrease in order to balance the interest rates. Pangatlo, bond yield is the return or monetary benefit or loss on an investment, whereas the bond price is the monetary value of a bond. Next is yung While the yield is one of the major factors considered by the investor while investing the calculating the return, the bond price is seen to check that how much the investor is capable of investing. Next is the bond yield is expressed as percentage value, while the bond price is monetary value. Next topic naman na i-discuss ko is all about clean and dirty price. Bond is usually priced as a percentage of par or face value. However, depending on a multitude of factors, bond prices fluctuate over the course of time. This is mainly because of the fact that there are numerous different factors like interest rate, compounding type that impacts the overall bond price. For bond investor, it often gets confusing to fully understand bond prices and also mechanisms. In their regard, two very commonly used terms are clean price and dirty price. So, ano nga ba ang clean price? Ang clean price is the price of coupon bond not including accrued interest payments. Ang clean price is typically the quoted price on financial news sites. This price does not include any interest accrued between the scheduled coupon payments for the bond. Clean price is also known as flat price. It is equal the present value of the bond's future cash flows minus the interest earned on the bond between the last payment date and the transaction date. Most financial markets, particularly in the US, quote bonds at their clean price. Accrued interest is added back to the quoted price to determine the settlement price. If we have dirty price and accrued interest values for a bond, we can find the clean price using the following formula. The formula for clean price is equal to dirty price minus accrued interest. Next is yung dirty price. Ang dirty price is a bond pricing quote which refers to the cost of a bond that includes accrued interest based on the coupon rate. Bond price quotes between coupon payments date reflect the accrued interest up to the day of the quote. Ang dirty price is sometimes called the price plus accrued. Ang dirty price rin ay nag-aalaw sa seller to calculate the actual cost of a bond since the bond might have accrued interest from the previous coupon payment date. So, the date of the sale would reflect the clean price plus any accrued interest calculated daily. This concept can be explained using the notion of accrued interest on the bonds, since interest is accrued evenly across these bonds. Importante din to consider the fact that after every passing day, the accrued interest is meant to increase. Therefore, when buying or selling bonds, the investor need to account for coupon payments that are due in the near future, as well as coupon payments that have already been accounted for. Dirty price accumulates that, and this price is subsequently communicated to the investor for their consideration. Next naman is yung differences between clean price and dirty price. Ang una dyan, yung pinaka-fundamental difference nila ay yung clean price does not represent any accumulated interest, while yung dirty price naman includes accumulated interest on the bond price. Yung pangalawa, clean price is always less than or equal to dirty price. Yung clean price can never be higher than dirty price unless there's a negative interest rate applied. Next is clean price just inform the investors about the face value of a bond. Yung other interest calculation need to be made by the investor himself. Ang dirty price naman is used by investor because it shows a lump sum value of the bond at a certain point in time. Next is clean price is mainly used in US, while yung dirty price naman is ginagamit sa UK. Yung last, clean price stay the same across the life of a bond. On the other hand, dirty price tend to increase till the point where coupon payment is due. After the coupon payment is due, the price restore back to the clean price. In most cases, a clean price is a price that is used as a benchmark for comparison. Ang dirty price naman is ginagamit for internal workings and calculation in order to estimate the expected payoff from purchasing a specific bond.